Hi, my name's Diana Britton, Managing Editor of Rep Magazine and WealthManagement.com. I'm here with Gary Martino. He is the Vice President of Sales and Business Development at MoneyBlock. They're an independent broker-dealer that sort of specializes in options and advisors who use a lot of options, right?
Correct.
So, Gary, I mean, tell me, should advisors be using options, trading options?
We think reps and advisors should definitely look at the opportunity using options. We think it's a crime that a lot of retail clients have better option capabilities with their discount firms than professional investment advisors do with their broker-dealers or custodians.
Yeah.
So it's our goal to try and not necessarily promote options, but at least make the tools available to them should they decide to utilize options. And we think there's a lot of great strategies that professional investment advisors can take advantage of right now, especially in a low interest rate environment.
I mean, why should they be using them? Is it, you were talking to me earlier about how they can generate income. How can they generate income for their clients?
Yeah, like for example, there's dividend stocks. Like you can invest in a dividend security, pays a decent dividend, generate a small yield, and then utilize a covered call strategy. And you can do that monthly, you can trade weeklies, you can do it 3 or 4 times a year, just depending on how active that particular advisor wants to be in managing that account.
Yeah.
But just another way to generate yield with a relatively low risk tolerance. There's risk mitigation, let's say. We have customers that have huge gains on stocks and they don't necessarily want to sell those stocks because they don't want to miss continued gains in that security. So we're trying to get them to look at buy a put. You buy car insurance, you buy house insurance, buy a put. It's like having insurance on your portfolio. Why risk, thousands of dollars in gains, at the opportunity to maybe missing some, and so buy a put.
Yeah.
Cheap insurance.
What are some of the risks involved? I mean, people think that people say they're risky.
Absolutely. There's risk. It just depends on the type of position. There's uncovered options, naked call, for example. I mean, stocks can go up an infinite amount. So if you write a call without owning the security, you have an infinite loss potential. But there's also positions that don't have a lot of risk. I think the biggest thing people have to get past is that an option's a diminishing asset. Whenever you purchase an option, it has a limited lifespan, and as that life goes forward, you're going to lose some value. But again, there are positions that have very limited risk, like a covered call strategy. Yeah, there's certain situations where you may miss some gains on a security where it's capped at the strike price on a call, but when the stock goes down, you're increasing lowering your cost basis, generating some additional income, and chances are, in order to sell that stock, you have to buy back the option. But with the stock going down, guess what? The call is going to go down as well. So you can use that gain to offset whatever you might have lost on the stock. So again, it just depends on a different type of position. There's always risk in any type of investment, but we think options don't necessarily have to be risky. There are ways that you can use them to actually mitigate risk. Yeah.
I mean, you're actually telling me earlier that they are, in many cases less risky because you're not betting that much on it.
Right, absolutely.
Right? So can you explain that?
Sure. You could, Apple, for example, go out and buy 100 shares of Apple, you're talking several thousands of dollars, hundreds of thousands of dollars. I think Apple's going to go up. I can go buy a long-term option, maybe spend a few $100s, and I can still participate in some of the gains on Apple without having to risk all that capital. So in some cases, it's a way of being able to invest in a security that has upside potential, or even other way on a downside. Selling a stock short, I have to go out and borrow that stock. There's a margin requirement, or I can just go out and buy a put.
Yeah.
Especially in a retirement account, you really can't go sell a stock short in a retirement account, but I can go out and buy a put, and same thing.
Is there any particular things that advisors should be doing with options? I mean, how should they be using them in their clients' portfolios? Should they have a certain allocation to options?
I think it's going to depend on the actual individual client, in all honesty. I mean, there's lots of different option positions. There are strategies you can utilize for a client who has a higher risk tolerance, condors, butterflies, credit spreads, debit spreads. Customers are more conservative. We talked about IRA accounts. Utilizing a covered call strategy, buying a put. I mean, there's so many different strategies out there. Just, you know, I think it gets to knowing your client, understanding what their needs are, what their risk tolerance is, and then trying to find a strategy that's going to work for them. And it could be a combination of stock and options, ETF. I mean, it doesn't matter. Again, with our firm, our thing is not to, well, how do I say it? Trying to empower the reps or advisors, really give them the opportunity to utilize options by having those capabilities. Whether they choose to do so or not, it's up to them and their client, but we want to make sure that they know the tools are there for them.
Yeah, and they really need to be educated, right, about
Absolutely.
all these different strategies and butterflies.
Not just them, but also being able to educate their clients as well.
Yeah.
Right, and so that's definitely an educational component to it.
Yeah. Well, thank you so much for taking
no
the
problem.
time
Thanks
here.
for having
really
me.
Appreciate it. And this is Diana Britton with wealthmanagement.com. Go to wealthmanagement.com for more information. Thanks.